Hello, everyone. Welcome to Robotti and Company's Fireside Chat with Louisiana-Pacific Corporation. I'll start by reading some brief but important disclosures. Please be advised that this event is being recorded. This presentation is for information purposes only and should not be construed as investment advice or a solicitation to invest. Past performance does not indicate future results. Investing involves risk, including loss of principal. Robotti Securities LLC, member FINRA SIPC, Robotti and Company Advisors LLC, and an SEC registered investment advisor. If you do have a question during this call, please feel free to enter it into the Q&A box on Zoom, and we will do our best to get those answered for you. We are pleased and fortunate to have with us today the management of LP. Joining us are Brad Southern, Chair and Chief Executive Officer, Alan Hawkey, Chief Financial Officer, and Aaron Holwald, Vice President, Investor Relations and Business Development. Now we'll turn it over to our Founder and Chief Investment Officer, Bob Robotti, to kick it off. Bob?
Thanks, Mike. Thank you all for joining us. So first, I want to frame the conversation because I really think it's important to have a 30,000-foot view, right? The world too much focuses in on what are OSB prices today? What are they going to be tomorrow? All of those kind of fundamentals. And therefore, the myopic viewpoint you have, you don't look at the bigger picture. So what I think we want to emphasize the fact that Louisiana-Pacific is in the process of a significant transformation from being a commodity producer in a cyclical business to one that makes specialty building materials with further segmentation in the otherwise commoditized portion of their business. And in that process, that's transforming the financial aspects of this business. And it's a great time right now because here we are testing how that transformation works. Is it real? Does it work through those numbers? And of course, look at capital allocation, because that's what we if you do look back, I do think I will highlight that since 2018, the share count has gone from 144 million shares to 72 million shares today. So part of that cash flow facilitated the repurchase of shares, so improving per share numbers. But of course, that still enabled them to do all the transformation of their business to grow out the siding business. So therefore, that's what we want to talk about today. I do think, so A, how that transformation has worked, how it's manifesting today, and what the future 3 to 5 year and even longer outlook is, because Buffett pointed out at the annual meeting, everybody has too short a viewpoint. If you have a 5-year, 10-year viewpoint, that's how you can make money in a differentiated way. So with that, so I've given you a lead in. So tell us how the business really has transformed and is transforming. And so please go ahead with those comments.
Thank you, Bob, for that introduction. I hope Aaron was taking good notes. That'd be a good way for us to start off an Investor Day presentation. We've been at this about 6 years now. It started, at least this unique version of the strategy started when I became CEO, which is July. It'll be 6 years in July. And we spent about 6 months with a complete strategic overview of the company. And really, out of that analytics that we did, we really, not that we didn't already know this, but it just pointed to how fortunate we were to have a siding business that, that time was about half the size it is today, but was growing, had stable margins, used a technology that we knew a lot about, and really focused, from a financial standpoint, if we wanted to, create shareholder value, the best avenue for doing that is to really double down on that siding business and put together an aggressive growth strategy, which we did. Historically and through today, all the mills that we have that currently make siding used to make OSB. A little nuanced in Holton, but that's still true for Holton. And so what we've done over the last 20 years and accelerated over the last 6 is this taking the opportunity to convert mills that historically made commodity OSB into the siding product line, which is sold off of a price list, you can generate demand for through marketing and selling is not traded like a commodity, which a lot of our OSB volume is. So we looked at it as an opportunity to secure our margin profile, to become less volatile of a company by converting these OSB assets over to siding. And we felt like we had a product that had, even though we had been in the business 5 years ago, we saw it as a product that still had a ton of market share penetration upside. And we can get into that as we go through this, Bob, but that's really our move into repair and remodel. Our move into pre-finished siding has been our entree to accelerated growth there. Hey, but we still have a big stake in OSB. We're still the second largest OSB manufacturer in the world. And while we have aggressively pursued conversion, there are assets, particularly in the southern tier part of the U.S., that would be difficult with today's technology to convert to siding. But man, we had 2 really, really good years in our OSB business during COVID, which to a large extent, 90% of the funds that we used to buy back 72 million shares, Bob, came from the cash flow we were able to generate in OSB through the COVID years. And we're good at making OSB. Our strategy there is to get even better from a productivity standpoint. We have an OEE strategy that drives efficiencies at the mill level, including with the use of capital, but then also supplement that with our structural solution strategy, which is a strategy to create new products in that OSB space that allow for upside additional margin. Most of those products are still in some way tied to the commodity price cycle, but what we do is add a coating, a overlay, sanding, or some unique feature that allows us to get incremental margin above the commodity margin cycle, which does not to the extent siding, but does create a little less volatility in that business. Since we've been on this strategy, we decided to divest the EWP business. We felt like it was highly commodity. It was also 100% tied to new home construction. And we were a relatively small player in that business. We exited that last year. And then we do have a business in South America that makes both OSB, or we'll say all 3, commodity OSB, structural solutions, and siding. That business has been one of geographic growth, where we are able to penetrate geographic markets that aren't currently using stick frame construction, and slowly convert those over to stick frame, which allows for the use of OSB and into more of our composite wood siding. That's relatively small business for us today, but we do see good possibilities for growth, and the margins there have been relatively strong. So as we look forward, why we are still excited about all aspects of our business, I'm bullish on the long-term outlook for housing. I feel like the demographics and the underbuild since the great housing recession, a decade or so ago, I don't think demand will be the issue over the next 5 years when it comes to housing, whichever generation it is, moves into the home buying years in their 30s, which has been delayed. We see a lot of opportunity for single family construction to be strong. And we plan to be around to service that in both our OSB segment and our siding segment. But also, as housing construction has remained constricted as far as ability to produce additional housing in the U.S., the housing stock has aged. And that is why we are also excited about the repair and remodel opportunity that we have, particularly in siding with our pre-finished ExpertFinish siding, to be able to service a growing repair and remodel business as well. So we feel like we're in a good market. We feel like the long-term outlook for housing is really good. There's going to be choppy quarters over the next 4 to 6 quarters, I believe, but I do think the trend is going to be upward from where we are today. And I think we're really well positioned, given the investments that we've made in capacity on the siding side, to take advantage of our ability to grow and gain market share in siding and in structural solutions, though that hasn't required as much capital investment to enable us to do that.
So let me digress to financial things right now. So that's operationally, strategically, how you're changing. It seems to me we're at an interesting point, right? Because there really has, obviously, home building has slowed down dramatically. So therefore, to me, this is interesting because it tests the model and how the conversion is happening. And, you know, where are you today in terms of at a low point in the cycle, the economics, where you stand today, and what that's facilitating you and demonstrating the conversion underway and its financial benefits?
Yeah, well, we're committed to, you know, we were on a managed order file in siding for almost 2 years during COVID. You know, managed order file means that we had more potential orders than we could produce. And so we allocated production for a couple of years. Late in COVID, we were able to convert the whole, well, so let me do dates. On January of last year, Holton Line 1 came on board with us to provide incremental capacity. As we ramped that mill up last year, all that capacity was absorbed. Q1 of this year, we converted a very large OSB mill and our last OSB mill in Midwest US over to siding. That's the Sagola, Michigan mill. That mill is currently being ramped up into production. Now, given the relatively softness of the siding market the last couple of quarters, you know, we're having to do some, we are taking some downtime across our system to balance capacity to demand. But we're in a really good, post the Sagola conversion, we're in a really good position from a capacity standpoint to service at least the next 2 years, even under an aggressive growth assumption or housing recovery assumption. And then, as we announced just a few weeks ago, we purchased a facility in Wawa, Ontario, which was an OSB mill under construction, which would make a really fine siding mill. And now that's the next mill up for us as far as additional capacity. We've owned the mill for about a month, so we're currently doing detailed engineering. We had announced previously a conversion of the Holton Line 2 over to siding, and we're also doing engineering work to see how much of that equipment that we had purchased under a PO could be repurposed over to the Wawa facility. I could see that mill coming online probably 2025 is a reasonable time. We could move that up 6 months if we needed to. We could certainly push it back if we saw continued weak housing. When we do these, now that we are ahead of capacity, which the Sagola conversion done for us, we now try to time these conversions in a way where we can, we always want to be at least a year ahead of that. Sometimes it could be hard to get right, but we certainly don't want to have idle siding capacity around waiting on the market to come. These conversions have gotten more expensive as they have gotten more complicated. So we're doing both a market study to understand when we need Wawa, what products we want it to make, but also doing the detailed engineering to make sure that we can get it ready when we need it. So that's been, and just on the OSB side, more of a maintenance capital scenario there in support of our OEE, our efficiency program, though our structural solutions aggressive growth strategy does require some capital, but it's modest in comparison to what we're doing over in siding.
Could you, so OEE is a concept that I'm sure it's explicable. And of course, the numbers are kind of in the mid 70s and it's a percentage. And since it's a percentage, I tend to think that the goal is, or in theory, 100% is the number. But what is it and how does it measure? And it's a number of variables. And what is your expectation as to, in a mid-cycle, where should that be? Where should you be? Those percentages come out.
So the scale's exactly right. If you had perfect production, which is no downtime, 100% A grade, and you were running all the machinery at its peak speed all the time, that would be 100. That is not attainable with human beings and gravity and friction, still exist in physics. The rules of physics and the rules of human nature 100% will never be achieved. But we do believe 90 is certainly achievable. And then once you get, and Bob, let me just say, we have got to 90 once. And then when we did, under our current program, we went back and reset the speed and the speed metrics to make sure that we will continue to challenge our operations. So we got to 90, and we did a reset back that knocked us back to in the 70s. But so our long-term view of our current way we measure it is to get back into the low to mid 90s would be reasonable, especially for the facilities that run a more limited product offering where they don't have as many changeovers. That's how you get the 95. The mills that are more flex mills, may not ever get there. But what that means is we've got 20% capacity hidden in our OSB business that doesn't take a ton of capital to go and get. And so if you think about every one of our mills with 20% upside on volume, that's another OSB mill buried in our current, footprint. So, and that is a lot more efficient use of capital is to go get that production than to go and build an OSB mill and try to make a return off of that. And so that's why it's such an important focus for us. It also, if you can imagine, helps immensely on cost and margin. But really what we want to make sure we're doing is get all we can out of our assets from a productivity standpoint.
And generally, how does that work its way through? So that's what it is. You have additional product, additional price, additional gross margin on that. And that's effectively incremental adding in. And of course, do you run actually lower cost per board foot that you're producing? So there's a little bit of a cost improvement, but it's really more volume and the margin you're making on the incremental volume. And you'd want to do that, obviously, in a strong market, therefore, that has end market demand for that.
Correct. So certainly the big driver is incremental sellable product. But you think about it, the margin on that is more than average because you don't take any more people. A lot of times it don't even take any more raw material because if it's a downgrade, you spent the raw material to make bad product, so let's spend the raw material cost to make good product. So it's a very high margin lever in a business like siding too, but in OSB where that incremental production comes with a very low marginal cost. And then I will just on so you get more production. Don't necessarily always want that, in a commodity OSB cycle. But I would rather be running efficient while I run and then take hard downtime where I can remove cost from the system versus running inefficiently in order to make the same amount of production. So we have, and I think we demonstrated this in Q1, while we run at the highest possible efficiency. And then when have met the order file, then we'd rather take hard downtime so that we have the ability to take cost out of the system.
Let me ask a question, and that is, I believe oriented strand board plants are different than other kinds of plants in a way. And I have the impression that they run 24 hours a day, 7 days a week, and they run at one speed. So it's not multiple shifts. It's always running full 24 hours. There's no shift potential. So therefore it runs or it doesn't run. So therefore that also, and once you've made oriented strand board, you can't store it externally because it's subject to the elements. And so therefore manufacturing it is this little bit of a difficult process, right? Because you only run at one speed, you run the plant, and therefore you're going to produce something. Is that accurate? And how, if that's true, is that also true of the siding business? And therefore, once again, there's one speed it runs at.
Yeah, so it's somewhat binary. You're either running or you're not. And then, yeah, I mean, look, you can practically slow the press down and in order to make less product. But again, I don't, and look, there's been times in our long history we've done that, but I'd rather run to, peak potential capacity while I'm running. And so that's the philosophy that we've taken. It is, our facilities are relatively low manpower. It's highly automated. I know it doesn't sound in this industry like you get a lot of that, but and I was at a mill last week, and I walked from where the wood enters the mill to the finishing area where we package it. And I didn't see a single person except when I walked through the control room. There was a couple operators in there. Now they were. I mentioned that to the plant manager. He goes, "No, we tell those people to go and hide when we're on a mill tour." So I'm sure there would normally be more folks there, but it's just not a lot of. There is no hands-on intervention between the wood entering the mill house and the press. Then once you get to finishing, there's a lot of traffic there. So yeah, so now let's compare that to siding. Very, very similar. The siding has a lot more SKUs. So there are more product changeovers in a siding mill, but and then there's a lot more labor in finishing, because we are doing cutting, painting, grooving, a lot of stuff in finishing that we're not doing in OSB. And so there is more of a downtime, or especially slow down cost associated with covering that labor expense in a siding mill versus an OSB mill. So it's more costly to run slow or to be down in siding versus OSB. And so we have to take that under consideration when we're scheduling our plants.
So let's digress for a moment, because clearly an oriented strand board, what you've done in many cases is, of course, created different kinds of boards that really do have specialization, right? So both that and in the siding business, you continue to do things to change the mix, change the price, change the volume, change profitability. So therefore, those are drivers too, in terms of, tell us about all those things and how they work.
Yeah, well, on the OSB side, so let's just start with commodity OSB. Commodity OSB, simply speaking, is a 4x8 panel and for those who aren't familiar with the industry, it's when you see a house being framed and they put the lumber up, we don't make the lumber, but then the sheathing that goes on the outside for 80 to 90% of the applications for framing, that's going to be OSB. The other 20% to 10% is a little bit of plywood and then some other plastic stuff. But OSB is the primary sheathing element for the vertical wall and the roof and the flooring, for that matter. Now that's traded we have a trading floor here, and that product is traded every hour that we have somebody in this office selling OSB. Now, what we do with that, so let's go to the most value add OSB product in our portfolio is FlameBlock, where we take magnesium oxide and coat and some other stuff and coat a sheathing with OSB commodity blank, and that makes that product fire resistant, and it can be used in interior walls and multifamily as a fire. As fire protection between multifamily kitchens, in an apartment complex, as an example. That product, by the way, we do sell off a price list, so that's not in any way connected to OSB. It's sold like siding. Let me go down to the other end, maybe the lower end. There's some things we do with resin, primarily to beef up the weatherability of our OSB substrate, so it can be used in a flooring application that might get rained on during construction. So that would, and then we have two more SKUs above that in flooring, where we make it even richer in resins and make it more robust, so it could take the warranty allows for a longer exposure to the elements before the roof has to be on the house. We are the number one. Another example is we are the number one manufacturer of Radiant Barrier. Our brand is called TechShield, where we laminate aluminum foil, think of it that way, on a sheet of OSB. And in the southern tier states, it is pretty much now standard on all new construction that you put this Radiant Barrier as the roofing panel, And then radiant barrier is on the inside. The sun hits it, bounces off, and it keeps the attic cool. So you don't need as much air conditioning capacity to cool the home. We make a WeatherLogic product, which comes with the Tyvek, the house wrap, already laminated on it. And so that's what we're gluing, we're coating, we're sometimes cutting grooves in flooring so that we can differentiate the product, brand the product, and then upsell the product over commodity OSB.
And what percent of the OSB that you sell now is structural, different products, therefore different price point, little different cost, but I imagine, definitely better margins.
We have incremental margin above the cost that we watch closely. And, currently we're running low 50% structural solutions. Our near-term goal is 70%. We have a plan in place to realize over the next couple of years or so. Bob, I would like to, it'd be great to get to 0% or 100% structural solutions. That's probably not practical completely. Some transition boards you want to run commodity, but kind of like OEE, I'd like to get to 90% and discontinue selling commodity OSB. That'd be a great day for us where we're not trading product daily, on our trading floor. As we converted these mills, over from OSB to siding and reduced our footprint, one of the ways to make less commodity is to be making siding in that plant that used to be making commodity OSB. And so it kind of all fits together. And I want to make one other comment on structural solutions, unless you have more questions about it. One of the a huge advantage we have in that area is those products are sold. I mean, they're not just traded. And so there's a brand associated with them. There's warranties associated with them. And so, we actively are marketing and selling this product to builders, to contractors, and we're using the sales force that we kind of justify because of our good siding margins. So it's the same sales force. We manufacture in different locations, but the product comes together in distribution, and this common sales force of over 100 people are actively selling those products every day. A more commodity-focused OSB company can't match that sales presence that we have across North America.
You may or may not know, but I guess since 2009, I've been a shareholder in Builders First Source, and it's a company I followed well and was a director of BMC for a couple of years also. How, if at all, has that changed? Because it seems to me as the distribution of products is different. And I guess maybe back 15 years ago, a lot of companies actually had direct distribution they maybe had, and obviously that's been eliminated. How's that changed, and what impact has that had? And is it even anything that you see manifesting today in terms of positives, negatives for you as part of the industry?
Bob, it's dynamic and it's changing. And I think it's a net positive for us, but we have to work at it being a net positive. So as home construction has consolidated around, highly more capitalized companies, national, large regional builders, the distribution behind that has had to consolidate as well. And Builders First Source has been a big player in that game. They are a huge customer for us on the OSB side and a meaningful customer for us on the siding side. And so what we, as the distribution channel consolidates behind the consolidation that's happening at the builder level, obviously the dynamic of around distribution changes. If you go back 10 years ago, we were, I would say, more two-step distribution. Builders First Source is one step to the builder. And we were more large regional, reputable large regional distribution. We have had to really change that and understand that I'm going to go to the builder now. Lenard, I'm just using them as an example. If they want to buy from us, and hopefully they do, they don't want to have to patch together distribution across their geographic, across the U.S. in order to get that done. They want to go to so ABFS and say, we're going to use all LP flooring. We want y'all to supply that for us through your distribution arm. And so they have certainly BFS in particular has positioned themselves really well to be that one-stop solution for the large national and large regional builders. And we are certainly in support of that. Not just with BFS, but with several that we have. So, and I only see that becoming more prevalent. I mean, I see the big national builders continue to consolidate the small regional players as a means to grow, and having access to land and permitting that's already in place, and that will mean that the large national distributors will have to get behind that as well. That jump ahead a little bit to the repair and remodel. Same things. Well, it's been that way with ABC and Beacon and some of these one-step distributors that have historically been focused. I mean, historically meaning 10 and 20 years ago, focused on roofing. As they've continued to grow their footprint and grow their companies, they've become meaningful players or significant players in repair and remodel siding. And so on that side of our business with repair and remodel, we really look at the one-step distribution that's servicing R&R, the home centers that are servicing R&R as a meaningful place for us to grow, because historically we've been pretty underpenetrated in that area of distribution, because we really never had to be there because we weren't in the repair and remodel business until 3 or 4 years ago.
And of course, as you're saying, in siding, the BFS is somewhat there, because that's really the ABC. That's really the roofing guy who's more likely to be the contractor to sell to siding, because he does roofing, goes siding. That's later in the process versus the framing earlier on, but BFS sells.
Dead on. And also, there's still in siding, it's still a big two-step distribution play where even local lumber yards may be the one supplying the siding even to a Lennar. Well, I'm not a Lennar, but to large builders. But the framing package, it's where our OSB is sold, man, that is going through the pro dealer network. So that's why it's so strategic for us to have those relationships with the pro dealers, because the OSB, including structural solutions, is going to flow through that. We have options on the siding side to get to new construction, but we don't really have as many options on the OSB side.
And so we talked about value add and differentiation in the oriented strand board. It seems as if the finishing part, and there's a bunch of segmentation and mixed issues that you can do in the siding part also, and maybe that also relates to this two-step distribution in terms of how that works, and therefore they're a bigger player still in how do you get to market in that product. Is that correct?
Yes. So see the SKU requirement, and I don't mean that we impose, but if you're going to, we make panel siding, soffit, trim, lap, and everything I just mentioned has multiple SKUs. Then you throw pre-finish in there with 12, 14 colors, and again trim and lap, some panel. That's not play into the strength of the pro retailer to carry that kind of breadth of inventory. The two-step distribution still has a place, particularly on the siding side, and they'll end up having obviously relationships, very, very valuable relationships with local lumber yards, but they're also going to be servicing ABC and BFS when it comes to carrying the infield inventory that's needed to service those markets.
Right.
And so two-step distribution is still very strategic to us in both businesses, particularly on siding. But it's going to be interesting to see how that plays out over the next decade as the pro retailers, the ABCs get larger. If they can accept rail car quantities, and not all of their locations, actually few of their locations can. That puts them in the position to buy direct from us. But then they have to balance that about whether or not they want to carry the inventory. So really, we have a really good network in place right now. But Bob, as you're intuiting there, it is changing. It's really dynamic right now, and the story hasn't been written of what that, siding and framing distribution network is going to look like in, 2025, or 2030.
Of course, I'll throw in my guess and estimate here. The change in the distribution for the OSB side of the business and for lumber producers has actually been a difficult transition because the industry hasn't been able to adjust production levels to meet the decline. And large distributors have been able to clean out inventory. And so therefore, all the burden seems to me to have fallen potentially on the producers. And that's like learning that process on how that's changed and therefore how one guy can control a lot of distribution and potentially accentuate inflows and outflows in demand. Do you see that?
Yeah, one of the hardest things for us to provide, investors on information on, and we're getting better at it. But for both businesses, and I think it's because it affects pricing, it's more dynamic in OSB. Between us, this primary manufacturer and the end user, there is a business with a balance sheet that is being managed very, depending on where we are in the economic cycle. And so, there are times when the housing numbers come out, for the last month and they're really good. And we didn't sell squat because it was coming out of inventory, in the distribution arm. Or there's times when it's like weak and we're predicting housing, Aaron says it feels like housing is going to be way down or way up, and it's way down, but we were moving product through that. And so in any quarter, we are more impacted by what's going on inventory and really balance sheet strategy in the distribution arm than we are on what's happening in housing. Now, in the long term, it all washes out. But man, you get to Q4 and people start managing inventory around year end, or you get to Q2 and you may have a customer that's optimistic about housing this summer, is buying everything you'll send them, and you'll have another customer who's for whatever reason, corporate has told us to watch inventories and they're not buying. So, now we've got enough diversity where a lot of that is offsetting, but there is this really interesting, inventory dynamic going on. And look, in COVID, there was no inventory anywhere at any time. So every bit of demand in both businesses was going right, from manufacturer right basically to end use, right. Sometimes with direct shipment from us to pretty close to end user. It's back to where the channel, has a significant position. I mean, I'll call it normal significant position, but they manage that to their own needs, and that can really, make the quarter, predicting how the quarter is going to end at the beginning of the quarter kind of difficult for us.
Well, I'd flip on that one. I'd actually say maybe by quarter things can happen, and as you point out, the distribution channel is changing, and so therefore it's adjusted. They're learning how to do that. You're learning how to do that. But it does seem to me as if you have fewer two-step distributors, there's potential less places along the line for there to be inventory. So in aggregate, there's less inventory stuffing that will end up, and therefore it should moderate over time. You didn't see it in this down cycle, but my guess is that over time that should be a positive effect. I would imagine there's fewer inventories because there's fewer channels of distribution.
I agree with that thesis, and I do think if you take the long view, it is more like that than it was 10 years ago, and it's a ton more like that than when I joined the company 20 years ago, where there was thousands of distributors. I guess that's fair to say, all with inventory strategies. As it consolidates, we may say it may be not great for us that there's less inventory in the channel, but at least there's more visibility to it. Because these sophisticated companies do provide us good inventory data that we can use to, for production planning. It's the smaller ones where we struggle to really know what's going on.
So let's go to the siding business. Of course, one of the things that clearly is happening is you're taking share, and clearly you have a strategy over time, right? So you already have identified you're going to go from, is it 2.4 billion board feet to 2.7 billion board feet, and then you can get to 3 billion board feet, and have a longer term plan to go as much as 5 billion board feet. Who are you taking that share from? Because it does seem to me as if, I look at James Hardy's numbers and it looks as if their volume's up kind of too. Am I wrong on that? But who, and what risk is there on a longer term basis is that the end market has that? Because that's the other part, right? The siding business not only has less volatility to it, and you saw that in the first quarter, right? Because therefore revenues and profitability decline in that business was drastically different than it was in the organic, the historic business. How does that work? And how do you have conviction that potentially somehow you're not oversupplying that siding business? Because that clearly is also not only less volatile, but an identifiable path for growth, which is something in the oriented strand board business, you don't necessarily have an identifiable path for growth in aggregate for that industry.
Yeah, so let me speak to historically, and I'd say up till last year, historically, we've been taking market share from vinyl, and so is Hardy, or so is Fireside. That has been the strategy. It's been the way we configured, our distribution strategy, our product strategy. I think, we used to be in the vinyl siding business back in 2000s, and I want to say when I was first, and I ran that business for a while, like vinyl at some point had 55-60% market share for new construction, and both new construction and repair and remodel, and that's down into like the 30s now. And so I do think it kind of got saturated. And then, then some of the realities of what it meant to have vinyl siding on your home became more apparent to folks. And so there's been this shift to, what to fiber cement and composite wood as a hard siding option. And there's no question, if you look at the vinyl numbers and you look at fiber cement and composite wood, and we've grown at their expense to largely. Now, as we look, I think there's still opportunity there, and we do benefit from high. That's PVC is the substrate or the input, and that's an oil derivative. So we, from a cost standpoint, we become more competitive, higher oil prices are. And I don't see that, I don't see, ginormous relief there over the next several years. But I think we do have a cost profile that will allow us to continue to take market share there. But that's not what we're banking on. We're banking on, we have a very, I'm going to back up and talk some besides just vinyl. Okay, so, our largest SKU grouping, I can't remember at this moment, is lap or panel bigger, but a very high concentration of our volume is in 4x8, 4x9 panel. This panel product is sold in basically every Home Depot store and most Lowe's stores, in North America. It is a DIY go-to panel for a project like build a shed, enclose a carport. We're competing against plywood for that. And we've been taking a lot of market. That's been a high growth area for us historically, and a very stable area. The product is just great. The plywood competitor is not primed, does not have an overlay, does not have a warranty. I mean, it's heavier. And so it's just a really, really good utility siding panel that's been, core to our business. On the trim, we make a composite wood trim. It's a great engineered trim. It's straight. It doesn't have wane. It doesn't twist. It nails great. Our main competitor there is solid sawn spruce and fir trim. We compete on the high end with some PVC trims, but predominantly we're focused on taking share from wood. What do we have that wood doesn't have? You have an overlay, it's primed, it has a warranty. You buy wood trim, you get none of that. So, and we hadn't talked about fiber cement yet, right? And so then you get to the lap siding, and that's where vinyl and fiber cement become competitors. Historically with lap, as I mentioned before, we've been taking market share from vinyl. But now, as we our entree with the BuilderSeries siding product has given us a cost advantage to go after the large national builders and regional builders with a very competitive lap substrate, where we have historically not been able to be price competitive. We now are able to do that, and that product is really has legs for this year. We introduced it last year. This is really the first full year we've gone through selling cycle with it, and we're very encouraged by what's happened there. And then our ExpertFinish is our lap siding that's going in to repair and remodel, which again is competing against vinyl, but also against fiber cement as the hard siding, another hard siding option for people that when they reside their house do not want to do vinyl again, or want to go to a more aesthetically pleasing and higher performing substrate. We certainly want to be an option there. And so what we've done, Bob, is we've tried to find new areas to gain market entry, to expand the available market as a means to, secure long-term growth of this business. And this is purely anecdotal. I'm not putting any volume on this yet, but we've been, in our last QBR, the quarterly business review, our marketing team, who reports out, every quarter, talked about beginning to see builders who are looking for cost-efficient housing that people can afford, starting to move off of brick onto lap siding, and have turned to us as an option for that. So we've never put brick as a potential, the brick segment as a potential, market for us. I'm not ready to call that yet, but it does make sense from both a labor and a cost standpoint. If affordability is a driver, and you don't want to go all the way down from, your next door neighbor's house is brick, yours house is going to be vinyl, man, SmartSide is a great option there. And so, what our marketing team does a good job at is finding new markets for us to play in, and then try to be innovative into those markets with this good substrate that we have, so that we're able to, garner market share there. So that's, but I would say why are we confident about the next 5 years? BuilderSeries, ExpertFinish, and then our broader offering of trim and panel products that I believe are, very competitive. When I look 5+ years out, we've got to find other new market areas to play in the siding world and continue to innovate into that, so that we can get to that, to those numbers that you mentioned, 5 billion feet.
So could you actually talk about the strategy in terms of building out the siding capacity, right? And so you were planning on doing Holton 2, and then of course you bought Wawa. So how did that opportunity come along? Someone was actually building a new oriented strand board plant, and how did that all happen, and how does that fit in? And it seems to me as if there's a whole bunch of flexibility that acquisition kind of gives you. Right? So
just a brief history there. The company was Forex, and they had an operating mill east of where Wawa is. They were in the process of building out. This facility had made OSB a long time ago, and it had been converted to a pellet operation. So a lot of the OSB equipment had been moved out as part of that conversion. So they had bought the site, or somehow got hold of the site, and were revamping it back to an OSB manufacturer. They declared bankruptcy as a company, and then just basically put, well, at least several assets across their whole portfolio up for sale as part of that bankruptcy. So we've actually bought this facility, and it was part of the bankruptcy proceeding. We had a bankruptcy judge that was in the mix there. And so, the opportunity for us was we really like the wood basket, which is something, because it's aspen based and it's available. We like that central part of the country. We can get folks to the facility from our Midwestern facilities as we get into production. I saw a note this week. We've already got a schedule in place for the existing employees to come to our mills in the U.S. and Canada and operate while there's nothing to do in Wawa. So we started that training, and then I think from a network perspective, it's in a really good position for us, centralized where it is. So that's how it came. There was also part of that decision making was there was concerns about that mill coming up as a commodity OSB producer right in the middle of the country. And so, if anybody ever makes OSB there, we wanted it to be us, though we have no plans to do so. We want to start that facility up on siding and just have it be a siding mill forever. And I think by the time we're able to get the engineering done on that, we're going to need that capacity. And then what we'll do is we'll go back to Holton 2. Now, Holton 2 was a lot more complex conversion than Holton 1 because Holton 1 already had a press in place we could utilize. This one, we were going to have to install a press to get it done. By the way, that's the difference. See, Wawa, the press is already there, so it's not as, quite as capital intensive in Holton. We were basically going to build another line right just next to the line that we had in Holton. So while we still like that project, Wawa had a much higher return, especially with the network effect it will have on the rest of our facilities. So that, Aaron, that would be somewhere around 600, 700 million feet.
Those two combined for 700.
Yeah, 700 million feet.
Yeah, Wawa's about 100 million larger than Holton Line 2.
Yeah. And so that puts us out, that's a good 5 or 6 years of growth there, given the fact that Segola is just now coming up. Mm-hmm. So we feel good about kind of the long midterm. Then after that, the options that we have is one, do what we were doing in Holton, which is add another line to an existing facility. That tends to have a pretty high return comparatively to our other options, because you do utilize some of the existing infrastructure, and then you do have a management team in place that you don't double in size. So a labor efficiency is gained, and then some amount of infrastructure efficiency is gained. And also you have great know-how about how to make, ship, package a siding product.
So just to go back on Wawa, so you were opportunistic because there was the fall off in the oriented strand board business probably helped bankrupt them. And so pricing coming down provided an opportunity, which you're financially in a position to take advantage of. You got the facility, you got the location, you got the press. The press also not only is dollar savings, but also time in terms of ordering a press and getting a press and all of those things. So there are multiple advantages you were able to be opportunistic on because the downturn provided an opportunity, and you eliminated what otherwise would be addition to oriented strand board capacity in North America. Absolutely.
By my whole career, and I think we might be around the same age just by looking at you. I've heard this, have a strong balance sheet, go into the downturn, and you can pick up assets. Right. And LP has never been we've had that strategy, but at the downturn, we never had any money or a balance sheet that could, we could do an acquisition with. And so it finally happened. I can say, yes, at least once in my career, that strategy did work. And we got what we believe is a really fine asset with a ton of potential for us, at a very reasonable, price. And so, we're excited about adding that to our portfolio.
And it also does seem as if you have some flexibility too, in terms of the timeline, the money, when you start to spend it, and that'll depend on what the market is and the absorption and the conversion you already had. You don't have to do it, but it's there, it's ready to go, and you've got a schedule to do that. Right?
And the thing is, if say it got delayed a year or two because of the market. Well, if they were going to go ahead and convert that to OSB, this is a little bit of a digression, but if we have to end up delaying that because the housing market's slow, we would really not want it to be making OSB in the down housing market. And they were, of course, the bankruptcy would have changed a lot of things, I guess. But if they had proceeded with that, it could have come up at a bad time. So we feel like it's almost worth it to be able to have that asset in our portfolio from an OSB perspective, and then we'll add a ton of value to it once we convert it into siding production.
And to digress for a moment on OSB, so of course that industry, like everything in the whole home building area, has had consolidation obviously over the last 15 years. And of course you attempted to do consolidation 10 years ago, I guess, when was it with Ainsworth, and it didn't work out. Is there any potential for any consolidation in the oriented strand board business from where we are today?
Well, there's still a few 1 or 2 mil kind of privately owned OSB manufacturers in North America. I know 2 of the families really well from being on committees and stuff with them. I mean, they're all in on OSB as far as I know, but you never know what could happen there. And so I think I do think for us, we have no interest in greenfielding an OSB mill in North America. I have to just be careful about what other, you can read what other people say about that, other public OSB companies say about that. So I do think consolidation, as far as trying to grow an OSB, the way to do that for the larger manufacturers is to buy assets like Wawa and, in the other Forex mill that was sold to Arbac. That's the way to do it. So I think we could see more consolidation, but also, occasionally these smaller private companies do build OSB, new OSB mills as well. Right. So, but you certainly can look historically and say that the industry is more consolidated today than it was 10 years ago, and a lot more than it was 20 years ago.
Right. Probably pretty peripheral, but you did have, as you said, you got out of the EWP business. You also had the Integra business that you were working on for a while and decided that's really not an avenue you want to go down, and shutting that down. So there's 2 businesses you're in, right? There's oriented strand board, and you're trying to bifurcate, of course, what you're making in that to have higher value add. And then there's the siding businesses. Those are the 2 businesses that you're in. That's it.
Yeah, in South America, it's kind of a hodgepodge of the 2 main going on, but it's the same business. I mean, we have 3 facilities down there. 2 of them we moved from North America down there, and we bought a 3rd one in Brazil. So it's just consider it really kind of it is more an OSB business with a lot of specialty product in it, and this does not have a North American pricing volatility. Similar to European OSB, it's not quite as volatile as far as pricing.
Good. So of course, temporarily, given business has clearly slowed down and cash flows have slowed down, that means, of course, you've starting the 4th quarter, you've eliminated buying back stock because you don't want to be penny wise and pound foolish, right? So you want to be able to have the capability to do things like buy Wawa, do those things. But you also did the dividend. Could you talk to the dividend? That is costs, and it adds to reduces a little bit of flexibility. Your determination, your thought process on the dividend.
In the context of our allocation, if you think about everything that's said, we've effectively got a siding business that's large, growing, and produces enough EBITDA to fund its own growth, plus or minus 50 million in any given year. And an OSB business that either breaks even, as it did in Q1 at a downturn, or produces truckloads of cash. At least it has in the past, and I would argue has the potential to do so in the future. Fundamentally because of its volatility, which is more of a gift than it is a curse now, more of a blessing than a curse. That excess cash flow, of course, will be used for share buybacks. In that context, I consider the dividend to be a relative drop in the ocean. Running at about $65 to $70 million a year, eminently fundable through either of those 2 businesses over a period like this. So I think the dividend's very safe.
Right. And did you increase the dividend, actually? Did you go from 22 to 24?
Yep. Now, if you think about the history of our dividend increase has been reasonably good, and we've kind of kept the cash outflow flat because as we account, we have that room to keep increasing. So in some respects, we still have the yield's been okay, and we have quite we bought a lot of time because we've been making dividend rate increases without any additional cash flow leaving the company because it's been matched by the share count reduction. So we can, I think, continue to afford a healthy dividend. I've no, and you yourself, Bob, you sort of asked and answered the question. The fact that we were ready to buy Wawa was not luck. The fact that it came up, arguably, you might say, was luck, but we were ready. And to answer an unasked question, that's the principal reason why we're not going to borrow to buy back stock, even though we significantly believe, but we believe wholeheartedly that we're significantly undervalued.
I do like the way you frame the cash flows in the businesses and how one can grow and finance its growth, and the other one generates relatively modest cash flow, but doesn't lose cash or generates a lot of cash, and therefore it can be opportunistic when it does generate a lot of cash.
It's a hard thing for the market to value, admittedly.
Right.
Nobody's sure valuing it.
Well, of course, though, it is a different company than it has been in the past. And so I think, unfortunately, impressions do hang around longer than reality potentially changes. But it's a good period of time in my mind, because that's what it is. You're manifesting, no, the financial metrics are different and the capability to generate cash is different. And so therefore, the business is a different business today than it was 10 years ago.
And the longer it takes the market to appreciate it, the more shares we'll buy back in the interim.
Until they see the error of their ways. And
Bob, I'm going to jump in with a quick question from one of the investors on the call. The question is regarding, if you look out over the next 5 years or so, how much share would you need to take from fiber cement in terms of your growth outlook and your plans to gain market share? And maybe as part of that, can you talk about the role of the builder and the contractor in making the decision on how they're going to approach you versus your competitors? Thank you.
Yeah, we don't have a solid, like, you know, this, we have to get X fiber cement market share to hit our numbers. I mean, I wish maybe we were forecasting at that level, but you know, the confidence comes more. Get to the question, but the confidence comes more from the diversity of our portfolio. We'll get it somewhere, because we'll find weaknesses or opportunities we can take advantage of. But let me tell you how we're going about competing more effectively against fiber cement. And so I mentioned it earlier, but the BuilderSeries Lap product that we have, we launched it last year, and I'm just going to real quickly, I know because it's more detailed than you want, but our lap product 16 foot long, and it's made on a 16-foot press. And so there's a kind of a bottom point cost you can get to, and there's not a whole lot of opportunity to take cost out of that. We were not able to be competitive on smoking deals at the big builder against Hardy's Simplank product that for whatever reason had a cost position we could not match. When we converted our Dawson mill to siding, Dawson is a 24-foot press. So we engineered this product to be able to make a 12-foot product, which is the same length as Simplank and all of James Hardy's lap products. And now just think about it. We're getting 2 boards off of every press cycle, where on a 16-foot press, you get 1 board off of it, you know, and it's now 1 blank that you didn't cut into length, cut into widths. But so we gained a big productivity boost from that. And then we did some other things in the product, which I'm not going to speak to, but other things to pull some cost out. And so now we were in a position to launch a product that we felt like, especially given its performance characteristics, would compete very well with Simplank. Well, when we launched the product, Hardy pulled Simplank off the market, so our timing was good on our launch because we had no competitors for a while. Now they've come back in with that product, relaunch it, but during that year where that product wasn't available, obviously we were able to have some really constructive conversations with the large national builders around utilizing our BuilderSeries. And so and just kind of all the growth that we get off BuilderSeries, the primary competitor is going to be fiber cement. Now, we may pick up some vinyl business as a result of the economics of that, but that product was designed to go head to head against Simplank and be competitive. And, you know, from our perspective, even though Simplank has been relaunched, our product still is stronger, support its own weight, is easier to install. So there are some characteristics around the product where it's going to compete. And we're not afraid of Simplank. I mean, it was better when it wasn't there. It was a lot easier to compete when it wasn't available. And so look, we won't get as many deals as we were going to get because now there's an alternative. But you know, we're really confident about our ability to grow that. Now, on the repair and remodel side, or their ExpertFinish, there is. So let me just back up a little bit. Or let me finish off on the BuilderSeries. The decision maker in that game is the builder, the national builder, their purchasing department, their regional purchasing department, and so we work through the builder to garner the deal to utilize the product. It is different in repair and remodel. In repair and remodel, it's a contractor game. And there are some large regional contractors. There's a lot of one-off contractors that do a lot of volume. Now, just to, for illustration purposes, the typical contractor is going to have two substrates. They have to carry vinyl. If the predominant issue in the purchasing decision for a homeowner cost, it's still vinyl, thin vinyl siding is the way to go. But most contractors are trying to sell up off of that, either to a thicker vinyl product or ultimately to a hard siding, which would be either us right now in the game, us or fiber cement. And so our original move into that was since we weren't in repair and remodel, was to become a viable alternative to fiber cement for the contractor who maybe didn't have a relationship with Hardie yet, or for whatever reason was looking for an alternative. So with the way we measure success in that, besides volume sold, is are we growing that contractor base? So you do that by making the product available, educating, certification, loyalty programs. So they garner points as they utilize the product. We create leads that through our website that we send to the contractor. That is really more than getting a free hammer. The leads are a lot more valuable to those contractors. And so our marketing effort, which was new to us, is marketing to a consumer, to a homeowner, which you've never had to do at LP, because we've been working through distribution or with builders, has been kind of a game-changing event for us. We're still learning how to do it as we bolster distribution, which we talked about earlier, to get to that contractor. But it is a game of recognition. There is, and we have a huge advantage, we believe, aesthetically with the product once it's installed. So once you get a neighbor to do it, the product looks great. Contractor loyalty comes from ease of installation. We hope from ease to working with our company too, but that's something that we do have to work on. And so, but I will say there's still a vinyl play in repair and remodel. So it's not like the only way we win in that arena is taking market share from Hardie. There's still plenty of opportunity in repair and remodel to build volume, build market share at the expense of vinyl. But ultimately, with a contractor, they're not going to probably carry both fiber cement and SmartSide, and they're going to be loyal one way or the other. And so we're trying to really bolster those relationships with an R&R contractor through a variety of marketing and selling techniques and reliability of service, to be able to continue to grow that. But look, and here's the thing too about both BuilderSeries and Prefinish. We are coming off such a small base. Growth numbers can be really, really large percentage-wise when the previous year was 0. And then you don't have to go too far in our history when for both of those products it would have been 0. So there's a lot of short-term opportunity for us just to get competent there. And then once the product is so well performing, which is why we've been successful growing it the last 20 years, we're really confident that it will build on itself as the product performs, on the side of a home, which is ultimately the test of how good this business is going to be in the future. And we really feel like our history sets us up well to be confident that both BuilderSeries and ExpertFinish is going to really fill a really cool place in the portfolio of siding options that are out there and provide us a big avenue for growth for the next decade.
Could I add something, Brad? This a point that we don't often make, except when we have sort of this expensive time, is that although nowhere is this really contemplated in our value creation model or in our sense of our intrinsic value, from a sustainability perspective, even though I think currently neither investors or customers care, the story for LP SmartSide is phenomenal and better than both of those competitors that Brad outlined. Clearly better than vinyl and better than fiber cement. So ultimately, if it ever matters, I think we're a clear winner. If it ever matters.
And what you just said was, you think from a sustainability point of view, the idea you have a wood-based product instead of one that is made from cement, which creates 6% of the CO2 in the world, or vinyl, which comes from a petroleum-based product, that clearly a wood-based product wins out in that consideration.
Yep, absolutely. Without any cynicism, without any carbon credits or buying anything, on a pure, very, very pure basis. I think we're a clear winner.
Some of our customers think their customers care. I've had conversations with my counterpart at some of our largest customers. They want to be able to tell homeowners that the products that go into their home have been sustainably sourced and manufactured, and they're
well, do you see that? It would seem to me like a state like California or even Utah. I know I've visited plenty of builders in Salt Lake City. They really definitely have an environmental concern. So the idea that there's a wood-based product versus cement versus vinyl, it would seem as if that really would have consumers, builders looking to build that product, and therefore, highlight that differential.
I think that concern is really there. I think it's also early in its development, and not all the criteria or the rankings or the ratings or the information that's out there is uniformly objective. There are plenty of pay-for-play rating entities and things like that out there, which LP doesn't need to participate in. But as those customers, as those markets become more educated about what the true environmental impacts of products are, there's just no comparison between sustainably manufactured engineered wood and anything that's petrochemical or cement based.
Let me ask you a question about multifamily, single family, right? So my understanding is on oriented strand board, right, the average size of a multifamily unit is 1/3 the size, and so generally the rule of thumb is for every unit of multifamily, it's 1/3 as much oriented strand board. So is that kind of right? B, when it comes to oriented strand board, when it comes to multifamily, do you sell more or less of the differentiated products, so therefore get better margins on that? And then C, when it comes to multifamily, somehow I'm thinking that's not a siding business, and so therefore there's not as much opportunity in multifamily. The siding is a single family oriented product.
Yeah, sure, Rob, I'll tackle that. Your rule of thumb is correct. A single family home on average consumes about 3 times as much lumber or OSB as multifamily through a combination of size differential and also shared walls, essentially when the building is being constructed. Our OSB goes disproportionately into single family construction. All of our OSB, with one real exception being FlameBlock. FlameBlock is designed to stop the movement of flame. It's particularly important in shared walls. So it's used in townhomes and multifamily disproportionately compared to single family. It's harder to come up with a rule of thumb about the consumption of siding for single family versus multifamily, mostly because not all homes are 100% sided. There are some that are partial brick or stone or things like that. But I would say that we are similarly underpenetrated in multifamily relative to single family in siding as well.
Bob, I will just add on to that. I would say that even more so than the large national builder, single family new construction, multifamily is very cost driven. And so there has been historically a reluctance on the structural solution side to do much more than TechShield. And it's crazy. I think flooring is a perfect upgrade for multifamily, but we've struggled, especially anytime commodity prices get high. You know, just the unwillingness to pay any more for added feature just seems to be diminished in multifamily. So we kind of, like most producers, we went in a down market. When the market slows, all of a sudden we get back in the multifamily business, which is what we're doing right now. But long term, it's not been a stable place for us to marry up with our strategy. So we've historically very focused on that channel.
We've been investors in manufactured housing since 03, 04. Do you sell much to, actually, I know one or two producers that actually use, were on allocation during COVID and whatever else. So do you do much in that space? Because I have this view that the idea over the next 5-10 years, that business actually has significant growth given its cost advantage on a single family home square footage, that it really kind of grows. Do you do much there?
I agree with your idea about the future for that business. And we have allocation was tough for us as it related to that segment, but man, our siding product is really well suited for that because again, not necessarily price point compared to vinyl, but as a siding alternative, our panel product is great as far as the efficiency of putting it up. And then when they move those units down the road, fiber cement has a tendency to crack and ours has more give to it. And so we historically have played very well in that segment. As I mentioned, we backed away a little while we were on allocation, but we're all in on that segment as a future growth opportunity for us, especially now that Clayton Homes is a Berkshire Hathaway company. They actually had a home at the annual meeting, put in the facility there that was SmartSide. They built with SmartSide, and so that's kind of renewed the relationship. I guess we're now distant cousins or something. And so, but we've had a relationship with Clayton for a long time, and I do feel like that they will gain disproportionate market share because of the ability element of their construction methodology.
I'm just going to jump in with one more investor question. The question is regarding EBITDA margins relative to competition. Do you see yourselves over time closing that gap? And is there any structural reason why your EBITDA margins won't be similar to theirs or at their level? Thank you.
It's a great question. I don't know enough about Hardie's manufacturing processes to answer the question as to whether or not our product is fundamentally more expensive to make. What I will say is that Hardie's twice our size, so they're benefiting from economies of scale that we don't yet have. About 3 or 4 years, a long-term EBITDA margin target was 20%. Then maybe a couple of years ago, we raised that to 25%. I think Hardie's got a more mature painted offering, and we're deep in the process of adding our painting operations right now, which are inherently inefficient when they are fledgling operations. So if you think about, I'll return to something that we said on the last earnings call, that if you back out the fact that we are investing in adding capacity, and that has some clearly and easy to identify EBITDA headwinds. We pointed to about $16 million in Q1. That's about 5% of revenue. So if you forgive me playing games with the numbers, if I back that out, because it is by definition temporary, then our EBITDA margin in Q1 would have been 25%. And so as we continue to add scale, as we continue to become more efficient in our painting operations, yes, I see upward movement in our EBITDA margin, irrespective of things structural that I'm unaware of.
So to what you just said, of course, is that you think 25% is an achievable goal even in the current environment in that business, and over time there are plenty of levers that you would think will provide opportunity to continue to increase that percentage number.
I believe so, yeah.
So we've got that down on record now. So therefore, if you don't hit it, we're going to send it to the comp committee, and then you're going to get dinged next year or something like that.
So,
Oh, well, there goes next year's bonus.
Well, just look at the waterfalls from recent quarterly earnings presentations, Bob. When we have volume increases or decreases in the siding business, the incremental EBITDA margin for that volume is closer to 50% than 25. So as the business grows, Alan's point about economies of scale, that's the driver for our increase in EBITDA margin over time.
You do point that out in the quarterly call, right? You did specifically say we lost that volume. That volume at 50% incremental EBITDA margin was it 27 million or something like that. So once again, you're publicly committed to some of the variability that you get when you have incremental capacity and sales, how much margin can potentially get added. So some of the people on the call probably don't know the company that well. Are there one or two things that are really great to understand the transformation that's kind of going on here at the company? Is there an investor day that you did, or a slide or a deck, or is there a slide or two that really is informative that you would push people to go, that will answer the questions that you have?
Yeah, there's a more recent investor presentation. Probably could stand an update. But the investor material from our last investor day is more stale than that. It's about 3 years old. We're considering doing another one relatively soon, and we'll let you know if we settle on a date on that one.
Well, I've been to an oriented strand board plant. I've been to the Joanna plant that Norboard has, probably 4 or 5, must have been before COVID or whatever else. So if you do the investor day, if you can then tie it in with the plant tour, probably of the siding business, right? Because that's probably more informative.
Sure. That's what we do. That's what we've done in the past. We've had plant tours at both siding and OSB mills in the past quarter or two. So if you're interested in that, don't hesitate to reach out.
Okay.
A couple of recent slides I would point the group to, Bob. There's a slide from the earnings presentation that we just had that shows the normalized growth of siding revenue and volume compared to single-family housing starts. Single-family starts are becoming a worse and worse great proxy for the siding business as it expands into R&R and
right.
other markets. But that's a thing that is primarily the result of our transformation, the accelerated growth of the siding business. I think the slide precedes it shows the growing share of volume within siding that's coming from ExpertFinish and the other higher priced products in the portfolio. They were about 10% of the volume in the quarter, but closer to 15% of the revenue. So they really punch above their weight in terms of price. Those really are both the signs of transformation. It's growth of the business and in volume, and growth in terms of price as we develop more and more specialized siding products.
Right. Hey, let me ask you, go ahead.
I addressed that quite just a little, not pointing to a slide, but we started with the transformation, and as we button this up, the thing that I think is different, what we have worked on to different is, first of all, really being mindful that capital allocation can drive value for our shareholders. And, I think we demonstrated a lot of credibility with that, with a share buyback and the dividend, the commitment to the dividend that we've shown. And so, we do, that is top of mind for us, is that given the cash generation capability of this company, how do we, if the market is going to value necessarily a potential upside in OSB, you can kind of force it by buying shares back. And so that is, that was obviously a very conscious thing to reward, our shareholders that wanted to retain the stock after we had a share repurchase program, to hang with us, and with the outlook for the siding business being hopefully the reason you hung around. And then secondly is, we do manage the business. We're an EVA company. We call it EP. But, the decision, the nearest example is the idea that now do we do Wawa or Holton next? And, we did the numbers, and Wawa has a higher EP by going first, so it moved up in line. And that is a demonstration that that's how we make decisions here, is based on an EVA principle. The transformation has happened internal. That has become the language in which we talk about business success at LP. And I believe we're mostly there on that part of the transformation. And it's really, hopefully we'll leave a legacy in this company that, we're here to drive value. And then we get to do all these other things because we're a management team that drives value. And so that's the kind of the philosophical transformation that's been that's happened and still happening. We still have work to do there, but I'm really proud of the way we've been able to link directly a reward to our shareholders, but by the transformation that we've been able to affect so far in the company.
Well, it is. It's really interesting. At the bottom of the cycle, you're able to pay a dividend, increase it somewhat, be opportunistic with an acquisition, continue to build out the pre-finished side part of the business. So to be able to have your cake and eat it too in a low point in the cycle is like so radically different than this company could have ever have done before in its history.
Yeah.
And with an opportunity clearly for an identifiable growth in a business with much less volatility, continued transformation. So
I'm taking notes again.
Yeah, nice ones.
no. It's good to step back and remind yourself, like, again, the 36,000 view, like, what do what's an investment in LP today, and what opportunities does it give an investor at a very modest valuation? So, anything else? Any other thoughts that you want to leave us with to kind of help people understand the opportunity that you are capturing?
No, I mean, I think we spoke to it all.
Something that struck me though is that at the mills, there's a sense of pride, not necessarily in the strategy, but in the products we make, which is tangible. When I visit mills, which isn't as often as it should be, but I am very much struck by the sense of pride in the products. It's meaningful, and if we do a visit and investor day at a mill, you'll see it. We don't need to do any preparation. These guys don't need any coaching from us. It just shines out, and I think that at a grassroots level, that has an impact in the way we all move in one direction as one force.
Well, potentially differentiating asset is people, right? It's not on the balance sheet, but a good, motivated, happy workforce.
And
it's worth a lot.
And it just feels different to know that the product you're making is different and specialized and sustainable, and not just another commodity that is exactly like the same product that the guy down the road is making. And the only differentiator is whether your competitor will sell it for $1 less.
Our job's not to fumble it. The ball's been delivered.
Mm-hmm.
It's the product. So everything we've talked about is whether or not we can, to use, I suppose, American policy, score the touchdown, but everything else is delivering that ball to us. Because the product is fundamentally what's really doing the work.
Right. Mike, any other questions that you have?
I think we hit on most of them, and it's been very great. Thank you so much for your time. Really appreciate it.
Thank you for
Thank
your
you
time.
guys.
Yeah.
And if there are any questions, Mike, don't hesitate to reach out to me. We'll get them covered.
Will do. Thank you very much.
Great.
Thanks. Bye.